do tonight is just once again provide more value to our community. We do believe that strengthening our community through this knowledge is just a focal point that we always want to keep very strong and the foundation of us. And just for being in our community, we always want to provide these free resources and this free knowledge. So yeah, we're going to get right to it. But before we get into our whole presentation, just a couple things to note. The presentation will be about 30 minutes long. And once we finish that presentation, then we'll go into about a 15-minute Q&A. So what it is that you want to do, you're going to write your questions in the general chat. What we are going to do on our end is actually answer those questions towards the end. So just something to keep in mind. So if you do have a question, maybe keep it written down, and then towards the end, we will actually post them and answer and address them. But once again, y'all, much love to you. I have a lot of respect for people that are willing to dedicate a Friday night to learning and improving their craft. I think that just shows the character of this community that we're building here. So props to you all, and I truly mean, welcome, and I'm glad you all are here. So the very first person we're going to hear from, you all see him in the live trading room every single day, managing it, having a great year trading. We're going to hear some things just on this whole topic of technical analysis, moving averages, and indicators. So Taj is actually going to lead us off. So yeah, Taj, take it away. Thank you.
Yeah, man. Yeah. Thank you guys for coming. So to kick things off, right off the board, we're going straight to one of our go-to strategies, and that's the ADMA. So let me go ahead and share my screen really quick. So if you like, go ahead and hop in to my stream here. Give it about a minute for everyone to join here. But as we do that, let me just go ahead and give you the brief definition of what a moving average is. So what a moving average does is it takes into account the prior X amount of candlesticks and forms an actual average line, right? So in this case, with the ADMA, it takes into consideration the prior 8 candlesticks and forms that moving average that you can see here. So on my screen, it's actually shown by the green line. And for us, this is essentially our go-to strategy. We trade, most of our setups are right off of the ADMA. We do ADMA bounces. And this is the key indicator that we look for because it's such a very sensitive price, such a sensitive technical indicator to price action. And as a day trader, that's what you want. You want opportunities to get in and get out very quickly. And the ADMA really gives you that opportunity to do that. So that are extremely different from one another. So the first example is actually today from Disney. Disney was a monster today, as I'm sure most of you know. Closed the day up nearly 14% on the day, and we took this trade and made bank on it. If you guys saw on social media, a lot of our traders took this trade and returns off of it. And the way they did it was the ADMA bounce. So the way that is Disney couldn't really find a direction in this morning, right? Had a big sell-off, but then slowly started to bounce up and found actually it's a new high as it broke out right here at 171.26. So what we decided to do is not just hop in Disney blindly, right? We wanted to look for a setup where we could evaluate risk and reward. So what we decided to do is once Disney pulled back to its ADMA and found that support, we entered into our longs. We bought our call options and trailed this bad boy up. We took calls right here around the 170, 170. And I think I was out around 173.40, somewhere around there. But we had traders go to bar by bar stops on this and milk it all the way up. And essentially weren't stopped out until, way up here around 175, 176. So the ADMA served all day as an extremely strong support and, just kind of formed almost like a railroad track as it slowly started to trend its way up. And what the ADMA is as long as price is hugging the ADMA, you're fine in your long position. You can look for buy opportunities every time it pulls back to it and has a bounce off of the ADMA and has that setup for you to enter into your long positions with that defined risk right off of the ADMA. So you may be asking yourself, well, okay, I know when to buy off of the ADMA, but what if it... With that being said, let's go ahead and look at Square. Square was also a name I played today. So I played Square here off of the 8 of May. It bounced here. I entered my call. I got into some calls around 220. And as it shot up to about 222, I took my profits. As soon as it popped above 222, I was out of the trade, made what I needed to make. I think Square on like a 50% return, 50% return off of it. And actually look what happened. Square pulled back to the 8 of May, but it didn't just pull back to the 8 of May. It ripped through the 8 of May. So what that tells us as day traders, for our room specifically, is we're no longer looking for any buy opportunities anytime soon until at least it gets maybe to its high of day or it reclaims its 8 of May, because there's a clear break of the 8 of May. And for us, that is a huge, huge set off, right? That shows that this stock is going to be into some trouble, right? So look at this. Imagine that you took this trade and you're not giving it past the 8 of May, right? You enter your long here around 220. Let's say maybe you're greedy with the trade, right? You want to give it some room for whatever reason. Maybe you think it's a home run trade and you decide to hold on to it. As long as you keep your stops at the 8 of May, you're going to protect yourself from big losses. And that's exactly what you want to do as a trader. You want to avoid big loss. And that's exactly what we had here. Had you gotten out at the 8 of May, right here around 220, you would have gotten out for nearly a break, maybe a small loss at worst. But if you held on and said, you know what, I'm going to give it a little more room because Square was going into all-time highs. You know, I hope it goes up. You would have been burned on this trade because it never gave you that opportunity that you're looking for. So not only does the 8 of May really give you that great risk-reward opportunity to make money on the upside, it also protects you on the downside for suffering any big losses. And that's something Alex and I, Santi, as well, we do that each and every day. We keep our tight stops because we want to avoid those losses. Now let's look. I have an example to go through, and that is Micron. And this is actually the 8 of May off of a reversal. So this is Micron as well. This is today. And Micron was actually really strong this morning. As you can see, it had a nice pop. And then it actually started coming down and it didn't find any support. Started breaking through support levels, broke through low of days. However, again, as a trader, you can't just short the stock here and, you know, make up your own stops or give the stops too much risk, because at the end of the day, it boils down to a risk-reward ratio. Is it worth taking this trade, although it may be the proper setup, right? And you initially didn't get it. When it hit the low of day, you didn't get that risk reward. However, once the 8 of May caught up, again, this green line, you had the perfect risk reward. You could have shorted the stock here as it broke right below 70.20. Throw your stops right there at 70.50. 30-cent risk. That's all it took on this trade. 30 cents. Enter your short at 70.20. You could have even added on this next play, because one rule that we have here is the 8 of May works once. You can try it again the second time. More often times not, it may work the second time. You could have added into your position here, but look at this. It went down to $70, $69.40. You know, it went down nearly $1 from that point, 80 cents. That's easy 2-to-1 trade on that. And as a day trader, you can't ask for more than that. 2-to-1 trades, if you can hit that every single time with a 50% success rate, you are going to be extremely successful in this game, right? So, I mean, this is a great opportunity of not only how to capture the reversal in a stock with the momentum to the downside, but how do you evaluate that risk reward to make sure that you're not taking huge risk on these reversal plays or huge risk on any trade. Trail it off of the 8 of May so you protect yourself. So that's going to wrap it up for me. I'm going to transition to Santi now, and he's going to show you some examples with support and resistance. So Santi, the floor is all yours, my man.
Well, thanks, Taj. So yeah, I'm going to be sharing my screen now, guys. So maybe Taj, if you stop sharing yours. All right. All right. You guys can see my screen. So if you guys just press watch stream, now you guys will be able to see my screen. So I'm going to go over now support and resistance levels. All right, guys. So for whoever doesn't know what a support level is, right? So basically, as a stock price is moving down and the price bounces from a particular level, if that happens multiple times, then we could call that level a support level, right? And now a resistance level would be if the price of the stock is moving up, it has resistance from the top, right? And that happens multiple times, then we would call that a resistance level. So we could see that in any chart, right? If you open up any company, a lot of times you're going to notice that the price starts bouncing on particular levels, and those would be the support and resistance levels. So I'm going to go over 3 different examples for 3 different stocks. So let's go. I'm here in Chewy. I'm looking at the past 20 days in the 5-minute time frame. So if I zoom in, I already have some levels drawn out. Here I see that the price actually rose this morning and it bounced back down, right? So then this could be considered a resistance level, right? Since the price moved up, it didn't break through, it was rejected and came down. So as we zoom out a little bit, we'll be able to see how well that resistance level held in the following days, right? So this day, it never went back near it. Following day, it didn't really approach it. But this third day, we see that it had this increase in price and it got near that resistance level. And again, all right, guys. So that's why it's important for traders in general, right? What I like to do in the morning, I like to look at the charts in a bigger time frame. So I zoom out and I see where the prices have approached and where it has bounced off of it, right? So we see, this resistance level for Chewy, it held for a while. But as we get here, right, we see here that it actually broke through. Right, this candle broke through that resistance, came back down. Right, it wasn't really choosing a direction until it finally grew and remained above it for a while, came back down, and it held. So now, once a resistance level no longer, basically, if the stock breaks through the resistance, now that becomes support. Right, so once again, the support would be if the stock comes down back to that line, now it bounces up instead of down. So we could see that here. That resistance level we had in the past days, once it broke through it, it became support, and now the price starts bouncing up from that same level. Now it's obviously not an exact price, right? That's where the whole risk to reward aspect of trading comes in. We see that the stock actually broke below that same level. So we would want to call that mostly like a support and resistance zone, right? It's not a support and resistance exact price. So we have to be aware of that as well. But we see that it became support, it came down, bounced, came back down, bounced, and it shot up, right? So that served as a great support once it broke. And now I want to show you guys actually a trade that I know in the trading room they took this past Wednesday. Right, so we see here the stock fell, right? And it had this nice bottoming tail bar. And we could say that this was a support level on that day, right? So now if we continue to follow that same support level, we're going to find right, this past Wednesday, the stock sold off and it basically bounced perfectly off of that support level. Right, we see that bottoming tail bar. You could have played this long and you would have had a very nice return. These support levels or resistance serve as also your risk levels, right? So let's say you would have gotten long after you saw this bottoming tail bar. If the price were to have dropped but beneath this support level, then you could have exited for a small loss. But in comparison, we see the big move it had, so it was a very nice trade to take it with this support level. All right, guys, so I'm going to jump in to another stock. Let's go to Facebook. And for those of you, just in general, if you don't know how to create these lines, right, these support or resistance lines, if we go here to the bottom where we see this pointer, this arrow, we click, and then we have this indicator here, this thing that says price level, right? When we select it, now we see a little pencil on the screen, and then anywhere, whatever level that we want. So for example, we see here at this point, this is after hours, after the market has closed, but we see that the price actually bounced from here. So we could double click any area and it creates that line, right? So let me go back to the pointer. And now look, that same line that I just created, look, just by looking at the chart that I saw that the price bounced, that same morning after, we see that the stock, as soon as the market opened, it came down, got very close to that same support from the after hours from the previous night, and it rallied, right, the whole morning. So it's critical for traders to be aware of these support and resistance areas, right? And look, as we continue to follow this same support level, if we go to this day right here, which was yesterday and Thursday, we see that the stock actually rallied around that same zone. It got rejected, right? That became a resistance level, so the price was rejected. And it just so happened that it was also accompanied by this moving average, which in my chart is the 200-day moving average, the 200-period moving average. And both of those combined give more conviction for a trade to the downside. So now let's say, again, right, Goldman Sachs, for example, if we go back. And as you guys look at more charts over time, you're going to just be able to point these levels out, right? Just basically whenever you see increases in price and that they start bouncing in those same zones, right? So here again, pre-market, we see that the price was at this level. I like to trade off of that pre-market level a lot of times. So as the price went up, we see that it approached that zone, have entered for it to the downside. You could have gotten puts or gone short, right? Same thing here. So we see the price bouncing from this level, and as we continue to follow that line, we see that it acts here as a resistance once it breaks through the support. So a lot of times I leave these lines on my chart just so that as the days continue, right? So let's say next week, obviously we don't know what the price movement is going to be the following week, but since I know that these lines have acted as previous support or resistance levels, then I am aware, since they'll be on my chart, and I'll be careful and I'll be able to look back at the previous days to see, you know, how much price action has occurred around these levels. Right? Let's see if I actually find another. Yep, so for example, we see this little spike here, and we see after hours here. If we were to draw that level, right, we see all the price action that actually happened around that level as well. Right. Again, bounced, and that acted as perfect resistance. Sort of had a nice short play right there. All right, guys, so in general, that's what the support and resistance levels would look like, right? I highly recommend for all of you to actually make use of these levels, and every morning before the market opens, just, you know, draw out these lines, right? Have your charts open, whatever chart you're actually looking to trade that morning. Find strong support and resistance levels and just keep them in mind, right? Like I said, they're not going to be 100% effective every time. They might break through, but that's going to be your risk, right? So I highly recommend you guys use this. But now with that being said, I'm going to pass this to Alex, where he's going to now talk about RSI, which stands for the Relative Strength Index, and he'll tell you guys more about that indicator.
Yeah, what's up, guys? All right, so the Relative Strength Index is one of my favorite technical indicators. So let me go ahead and share my screen so you guys can follow me on 3 stocks that are going to be great examples. So So let's see here. All right, let me know. I'll give everyone a minute before I get into it. So make sure that you go on the top right-hand side of the Discord and you click on Watch My Stream. And we'll be good to go. So the first two stocks that I want to go over are Tesla and Disney. And then I'm going to go over Facebook and one other name, NEO. All right. So the relative strength index is a momentum indicator. Stocks don't go just shooting up without some sort of consolidation and some sort of calming down period. In the same way on the downside, stocks don't just shoot straight down without some sort of consolidation period and then a continuation of that momentum or a reversal coming into play. So Disney today was covered by Taj, right with that ride up the 8 of May, and I like what he said. You know, it served as like a railroad track. That's exactly what Disney was riding on today. Very hot momentum. It was getting overbought to a certain point because look, in the first, let's say 11:25, so almost in the first 2 hours of the day, you had no serious pullback on the stock. The only first pullback you had was in the opening 5-minute candle, but that got taken out. And then you had your first bull flag formation. Maybe let's count this as one small one. You had your second one right here, and then it just ripped to the stratosphere. I mean, this thing was clearly hot today. But if you take a look, follow my mouse, take a look down here. I always have the RSI as a technical indicator to guide me on whether a stock is running too hot on the downside or on the upside. Here is something I want you all to jot down. If the RSI is ever above 70, you are getting into what's called overbought territory. When you are in overbought territory, at some point, the stock will slow down and pull back. Now, on the flip side, if the RSI is ever below 30, the stock is oversold. And at some point, there will be a bounce and there will be some sort of consolidation area, right? Now, it doesn't mean that the upside won't continue, or on the flip side, it doesn't mean that the stock selling off won't continue the trend that it's in. But at some point, there's going to be a consolidation, there's going to be a calming down period before it continues whatever trend it's on, whether it's on the upside or the downside. So let's look at Disney. We played Disney today. I mean, I personally did not play Disney, but a lot of traders did. Taj did as well. They played it once here, broke out, and they played it twice here, broke out. But then guess what? At some point, I think, if I'm not mistaken, Taj, correct me if I'm wrong, some profit-taking areas occurred right here at around 176. Some of our traders banked 274% on this trade. However, how much is too much? Look at the RSI. At about 11:25, 11:30, the RSI was at 83. Mind you, anything above 70 is overbought. So, look at what happened preceding that topping action that you saw there on that 11:25 topping tail candle. The RSI got way too hot, the stock ran out of juice, and it slowed down, right? There's the topping at 178.63, at least for the first, morning session, and it pulled back. But then follow the RSI. The RSI immediately started to calm down as well. And this line right here is the break below 70. But then if you follow the RSI and you look at the stock action, what occurred? The stock literally slowed down for probably a solid, until 1 o'clock? So it slowed down for an hour and a half before it attempted to pick back up with momentum. And look, the prior topping at 178.63 It's not a perfect resistance zone, but look at where the price action halted. Look at where there was clear resistance here at 179, between 178.63 and 179.51. It had no more juice in it. It was running too hot the entire day. And the RSI indicator is one of those indicators that I absolutely love, because it can tell you this ahead of time, right? It can tell you if there's just too much buying and not enough consolidation, not enough pullback on the stock. And that's exactly the story that Disney shares today when it comes to the RSI indicator. And as you can see, for the rest of the day, the stock, even though it climbed back up, had some overhead resistance here, stayed up here for about, let's see, 5, 10, 15, 20, maybe about an hour, and then sold off. Not much, but still sold off. And look at where it closed out on the RSI, 43, right? So it ended the day much calmer, right? It just wasn't going parabolic like we've seen on, many short float stocks or many biotech stocks that just shoot straight up, right? So Disney is a great example of where you could leverage the RSI indicator or the relative strength index to help guide you on whether a stock is running too hot. Now let me show you Tesla, which is a stock that I played today, and I took this trade where it was selling off a little too hard and the RSI fell below 30. I used the RSI as a guide to help me build confidence on when a bounce was going to occur. So the market started selling off a little bit. Tesla was clearly on a downward channel, but then look at what occurred at around 12:30 and 12:40. Look at where the RSI is at, right? The RSI, this line, if you see it down here, is the 30 line. The RSI broke below 30 twice, right? It broke it here at 12:20. It had a small little bounce. It kind of consolidated a little bit, came above the 30 mark on the RSI, but then it flushed again. And what happened? The RSI broke below 30 again. It's in oversold territory at this point. So I was watching Tesla very closely because I told myself, all right, if Tesla has some sort of bounce in this area, we all know Tesla, we call it the crazy. The crazy makes us money. So when Tesla gets crazy, we follow it. Right? Taj, we say that every day, man. So guess what happened here? Tesla got oversold. We have a bottoming tail bar on this red candlestick, and then the opening bar attempted to take out that red candle, but it didn't necessarily do it. The new bar opened up, sold off a little bit, and then rallied. When I saw that, I knew Tesla was going to be in play. So guess what I did? I immediately told a lot of the traders that stuck with me until the afternoon, all right guys, we have a couple of things happening here. RSI on Tesla is completely oversold. What do we also have here? An inverse head and shoulders formation. Here is shoulder number 1, here is the head, and here is shoulder number 2. It's not perfect, but we've got an inverse head and shoulders formation. This line that I just marked is the neck of the head and shoulders, and RSI is oversold. I knew Tesla was going to be in play. So guess what I did? I bought 6-10 calls on Tesla right before this 5-minute candlestick when it broke out. Boom! Immediately, right after, I was in the money. I actually held Tesla a little longer because I was already really good on the day. So I was kind of giving myself a little bit of wiggle room to see if I can get some more on Tesla. So my risk tolerance was a little high on this one. It rode up nicely, and then this 5-minute candlestick, not gonna lie, kind of scared the crap out of me, right? Because it pulled back pretty hard, gave back everything it did for the past 15 minutes. But what did I see? It held that 604.28 neck on the inverse head and shoulders. And the next 5-minute candlestick wrote up. So actually, right here, when it broke above the 8 MA, guess what I did? I doubled my position on Tesla. It wrote up, and I ended up taking my profits around this area for very nice profits. Guys, all of that, I know I just went through like a little bit right there. All of that occurred because of my observation on the relative strength index. Because Tesla was in oversold condition. I had an inverse head and shoulders formation that gave me confirmation of a nice rebound. And the stock, even though it pulled back, held the neck of the inverse head and shoulders formation, and I doubled my position, wrote it up, took my profits. So that was my trade with Tesla today. And if you want to take it even further, you have a nice channel that it formed right here. So it even held a nice channel that it created on a reversal play. All of that, guys, from this little RSI line right here. Because if you take a quick look at that. Once it bounced, that RSI never revisited in oversold territory. So there's obviously, and I do want to preface this, you don't take trades purely based off the RSI. The RSI is a support, or it's an additional indicator that can give you confirmation on a trade idea. Taj and I, and I'm sure Santi as well, we don't trade based off the RSI. Like, we don't just look at the RSI and be like, oh, something's oversold, let's just buy it. No. We need additional confirmations. The moving averages, support and resistance zones. The RSI, we purposefully left it last during this webinar because it is not a primary indicator, it's a secondary indicator that you should use. So I just wanted to make that clear because, you know, I don't want you guys to start taking trades purely based off the RSI, right? We can get into some danger zones, right, when it comes to that trade, or that, you know, just purely trading on that. So that was my Tesla trade. I went over Disney. Let's go over Facebook. So Facebook, very, very similar to Tesla today. The market was weak. Facebook has been very weak, especially because of the recent news that you've got 46 states suing the hell out of Facebook because they want to break up WhatsApp and Instagram, right? They want that they wanted to divest those businesses because they believe they are abusing, right, the marketplace. So Facebook has been a weak name that we've been trading the last couple days. Now, Facebook has been clearly being sold off, and remember what Taj talked about with the moving averages? My 8 MA is the red line. It's literally been trading off the 8 MA the entire day, downward to the downside. But then what occurred here? You have the RSI in the first time of the day. It was teetering on oversold condition the entire day, right? Didn't really break 30, but then look what happened here. Broke below 30. You got almost a double bottom formation, and I see what I saw right here was a nice neckline on that double bottom formation. So had you been watching Facebook here at these levels, you could have clearly identified this double bottom right here, looked at the RSI and said, oh damn, this thing is oversold, right? Nice bounce, reclaimed the 8 MA. There's a neckline at 271.42. All right, let's take Facebook long. Let's buy 272, 273 calls. Had you done that play, look, you would have never been stopped out of your break even or from your entry point. You would have never lost money on this play because you had the RSI supporting the thesis, the idea, the observation that it was oversold. You have a double bottom. You have a nice reversal. You have a neckline here to create as a entry point, and you had a nice reversal trend. And then let's create a nice little channel right here too. So we can create a channel from, look at that, beautiful clear reversal channel, and you don't even need to create this channel because you can clearly see the 8 MA. What did it do? Whoop! Just turned itself back around, crossed over the 13, crossed over the 20, gives you additional confirmation that your entry at 271.42 was spot on. So guys, once again, the RSI is just an additional support indicator for you to build conviction on a trade, right? And we use it every single day. We always make reference to it, and it just helps us be confident on a trade. And let's say we did get in on that trade, your risk was probably right here, 270.62. So you'd probably not be risking not even a full dollar per share on that trade, and you would have made, let's just assume you rode it all the way up, right? Let's just say you were a badass trader, you rode it all the way up, 274, right? So your potential reward on this would have been what, $2.60 with a total risk of not even $1. That is a great trade and a great opportunity identified with Facebook. And that type of trade is just something that we do every single day. I mean, I just don't know how else to say it. These are trades that we identify every day by using the moving averages like Taj talked about, by identifying support and resistance zones like Santi talked about, and by using the relative strength index. With that being said, I'm going to transition this off to Chris, because I think we've hit the 30-minute mark on the presentation, and we're going to go ahead into Q&A. So thanks for watching this Facebook trade and all the other trades that we covered. So Chris, let me pass it on to you. I'm going to stop sharing my screen.
Educators, man. Thank y'all very, very much, man. So like you said, we're going to have about 15 minutes of Q&A. So please go ahead and write your questions in the general chat. And as I read them out, one of our educators will answer them as well. All right. Anthony's question went to the webinar channel. Give me a sec. When setting stops on calls, better to use limit of call price of the call price or the ticker's price?
Hold on. When setting stops on calls, better to use limit of the call price or the ticker's price? What do you mean by that, Marcos? Do you mean the limit of the price of the ticker's price? Everything that we're doing, it's like if the contract is $2.30, but the ticker is 100. Right. Okay, I got you. So we're using the price of the contract or the price of the actual stock to set our stops, is what I'm assuming your question is? Okay, perfect. We use the price of the stock. So the reason is options are also, derivatives of the stock. So you want to use the actual stock ticker price because that's what we're trading off of, right? We're not trading off of the chart of an options contract. We're trading off of the chart of Facebook or of Tesla or of Disney, right? Whatever stock we're trading. So for example, when Alex said the stops on Facebook, let's say, I'm not sure what the price was, let's say 270, right? What you would do is if Facebook came down back to 271, let's say it traded up to 272 and came back to 271, we would then sell our contracts for break even, a loss, whatever it is at that point. But yeah, we use the actual charts.
Marcos, I also wanted to add a little bit onto what Taz just said. Now with options, you just have to be aware, depending on what your risk rule is, so for example, let's say you were to buy a stock at $10 and you're only willing to risk $1, right? Which means you would get if it goes down to $9. Now, if you were to buy, that means that you lost $1, right, on that trade. But now if you were to buy a call option, right, and you want that same type of risk, you have to understand that the option would over time lose value, right? So if your risk is dollar amount, then you have to be aware that as time continues, that risk of the actual stock moving would be going up. Like the ticker price actually, as time passes by, if you're only willing to risk every day that passes, that $1 risk that you had before ticker price would now be smaller because of that time decay in the option. So I hope I hope that was a little bit clear. I know it can be a little confusing to understand options if you're not familiar with it, but be aware that it depends what type of risk you're looking for, what you're comfortable with.
All right, cool. We have our next question.
If I may add,
Anthony. No. Go ahead.
Yeah, sorry. If I may add, I was just gonna on the options, something that I've been doing recently, and it has worked out for me, just to protect myself, just from the immense volatility that exists in the market. So like, if I get into some call options and the stock immediately rips in my favor, and I'm in positive territory with my position. Recently, I've been putting stops at my break even with my contract price, just in case if the stock just flops, like within a minute, I'll be break even on my contracts. I've done that personally to protect myself, because I would rather break even on a trade than to lose money on a trade. So I've been doing it recently, and it has helped me. So maybe that's something that you can incorporate. It is a personal preference of that style of trading. The challenge with it is that putting stops on your contract price does not directly correlate with the stock price, because the volatility and just so many different variables that are contributed to the options contract can just, it can poke you out, it can stop you out, and then, just with a very small pullback, right? And especially like if an options contract has a wide spread where the bid and ask is, maybe there's a spread of like 20 cents or 15 cents, whatever it is. I've been stopped out before by using that strategy. So, but I just wanted to throw that out there, just so just wanted to share what I've been doing. So yeah, just figured if that would help.
All right, very cool. Our next question comes from Anthony P. Alex, in your Tesla example, how did you decide it was on Tesla at 610?
Well, the Tesla contracts only gave me two options at the nearest price. It was 600 or 610. So I just chose 610. There was no other real reason, right, for the 610. 610 was the closest strike price that I thought Tesla could have achieved based on on the price that I got in on. So I just chose 610, and I always give myself 1 week expiration, especially trading on a Friday and choosing same day expiration. That's very dangerous. If the trade doesn't go in your favor, you could lose a lot of money. So especially on Fridays, I always choose the following Friday expiration, just to protect myself a little bit on the on the time decay and all the other variables that are in options contracts. But honestly, there was no other real good reason for the 610 calls. Not gonna lie to you. So that's why I chose it.
Awesome. Jack My J says, how do you identify where to begin the A to draw pattern lines and make decisions with? Is it different from a trend line or the same?
Maybe that one's for Taj.
Yeah, I'm sorry. I'm just trying to. How do you identify where to begin the A to draw pattern lines and make decisions with? Is it different from the trend lines? So the A, I don't draw the A. It's an average price that's constantly changing. So what I decided to do with the A is I combined some of the pre-market data. You know, as you saw on my screen, the white shaded side was the pre-market hours. So it's constantly being updated. So one thing I like about the A versus trend lines, we create trend lines, right? We create trend lines, and it's very subjective, right? You can, some people, for example, with trend lines will use the peak of the candlestick, body of a candlestick, right? And draw out their trend lines. And it serves as more of a zone. Right. And that zone is usually a little wider compared to the moving averages. The moving averages are essentially a zone as well, but it's usually a tight zone. It's not usually like a, let's say you're trading Apple. It's usually not like a dollar zone. If anything, it's like a 20-cent zone, right? But if you're using trend lines, it's a zone, because at any point that trend line could form a tail bar and it upholds, right? Whereas a moving average, it's a little more, it's not concrete, but it's much concrete than a trend line. And then, like I said, I don't have to draw out the A to May, because it's constantly being updated with every new candlestick that's formed, and as price action starts to move throughout the duration of that candlestick. So I just like moving averages because you don't have to draw it out. Everyone sees the same thing, right? If I were to draw a trend line out and Alex draws a trend line out, Santi draws a trend line out, it could be all different, right? It could be completely different trend lines. Whereas if we all throw the 8-period moving average, the A to May, on our charts on the 5-minute chart, it's exactly the same throughout. Everyone sees the same thing.
Next question from German, etc. Alex, RSI question. Wanted to double check my notes. If RSI is over 70, that means it's overbought territory. The stock will slow down. If below 30, there will be a bounce and consolidation. Did I get my notes right?
Yes. Now, let me just preface this. It is not, the RSI is not perfect, right? And it serves as a guide, right? So why do I say this? Taj and I, we've traded stocks in the trading room where the RSI was at 90 and that thing wasn't slowing down. It clearly was an overbought territory, and we were waiting for the slowdown period so that we can short the stock. But I mean, sometimes there is just so much momentum behind a stock that the RSI will literally hover at 80 to 90. So clearly we're using that indicator, and that indicator is helping us understand, like, okay, this stock is in overbought territory. What does that also help us do? If a stock is in overbought territory, I won't touch it, because at some point it's gonna pull back, and I'm risking my money for maybe a very small play when I know very soon it's gonna have a pullback. The RSI actually serves really nicely on the daily chart. So if you look at the daily chart on stocks and that RSI is very overbought, like on Micron, the other day, Santi, Taj, and I, we were all chatting, I think it was some evening, I forgot, probably during a meeting. We were looking at Micron. Micron has just been ripping since like $40, and it hasn't stopped, right? I think recently it consolidated, but in recent days, the RSI was, I think, Taj, correct me if I'm wrong, I think it was at like above like 85 on the daily chart, not the 5-minute intraday, the daily chart. And Santi commented, I'm gonna wait for the following day, which I think was a Monday, to short the hell out of Micron, because we knew that Micron was gonna have a daily pullback at some point, and it actually happened. So Santi, I actually don't even know if you took the trade, and if you did, good for you, bro. But that's one. Like I said, the RSI is a support indicator. Don't make big decisions based off that. But then on the flip side, if it's below 30 and it's oversold, you can start looking at maybe building an entry point or building a position to go long the stock for a nice bounce on it. So your notes are correct, but I kind of went a little deeper in my explanation just to preface to be careful as well with the RSI indicator, because it's not a perfect technical indicator to rely on, right? You've got to use all the other indicators that Taj and Santi talked about, which are stronger indicators than just the RSI. The RSI is a secondary support indicator, as I like to say.
Beautiful, thank you. All right, so we have time for one more question. Hey, Alex, just to confirm, you usually take options with 1 week expiration date. Can you elaborate why?
Yeah. So this is what I do. Like, let's say like on Mondays and Tuesdays, if I want to take bigger bets, more aggressive bets, I'll take same week expiration dates. But the closer I get to Friday, I will not touch same week expiration dates, because one mistake, one pullback, one trade that goes against you, for me, with the size that I take sometimes, I can lose thousands of dollars. So to protect myself, I give myself 1 week out expiration dates, so that if the stock pulls against me, all the other variables that Santi could do a better job explaining than I can about what influences options won't hurt me as bad. So maybe Santi, do you mind maybe touching on the other variables that are in the options and why we should always look at, like, you know, next week or the following week?
Yeah, of course, man. So for options, as you get closer to the expiration date, right, the options contract gets a lot more sensitive. Right? So what that means is that the delta, right? So there's 4 major Greeks, right, for options, that they all contribute to the price movement of the option contract itself. And as you get closer to expiration, the option contract moves a lot more for every $1 move that the stock has. Right? So if it goes in your favor, right? You could make 50% returns in a matter of minutes, but the same applies for the downside. If the same thing, you know, if the stock goes against you, you could lose a lot of money very fast. Now, if you go farther out in expiration, these Greeks, these factors make it so that your contract is not as sensitive to the movement of the stock price. Right? So if the stock does move against you a little, now you're not going to be down 50% all of a sudden. You might be down 5%, 10%. Right? So a lot of it has to do with your risk tolerance, like Alex said, depending how big your position size is. If you're willing to get out in a couple minutes, no matter what happens, right? If it goes against you, just get out and don't hope for it to come back up. So it all depends on all those things, right? So yeah, in general, like, to answer your question overall, the farther out you go in expiration, the less you're gonna feel that price going against you if it does go against you. But if it does go in your favor, you will also see less profit. So that's basically it.
Yep, that's exactly right.
All right, cool. So Marcos is asking, and for swing, best estimated or recommended? Not sure if he's talking about potential trades. I'm not too sure, but if anybody...
Yeah, he's asking for swing trades. So trades that you hold a little further out. That's totally, it depends, right? It depends on how long you plan on this playing out, right? Is it a momentum play where you plan on holding on to it for max a week? Or is it something a little more long-term where you see, okay, this may take a few months? For general swings, for momentum type plays, I would recommend a month. I would say bare minimum a month, because you want to really make sure time's not killing you. But if you're going a little further out, like let's say, okay, I think within the next month, Micron could get back up to its all-time highs, right? You might want to give it, instead of 1 month, give it 3 to 4 months, right? Give yourself some time in case the stock goes against you to where it's not killing you, right? Because let's say you go a month out on Micron, and it ends up pulling against you the first 3 weeks, but then that final week it starts to rally back up. You're behind the trade by a significant amount now, because like Santi just shared, it's going to be a lot more sensitive to price, right? it went so far against you, it ate away at your contract. By the time it recovers, you're still down on the trade. By the time it gets back to your entry point, you're significantly down on the trade. Whereas if you went a few more months out, you're not down nearly as much. You might even be break even at that point. So it's totally dependent, but I usually take whatever, just like as a general rule, take whatever number that you have, let's say a week, and just multiply it by like 3 or 4 and go that far out.
So we were going to have that as the last question. If somebody maybe wants to answer Christian's real quick, I would hate to leave Christian hanging. But we'll keep this as the very last question. When placing 1 to 2 month options, time decay is significantly less, question mark?
Correct. Yep. The further you go out, the less significant time is. And it can get cut by like half. So this would be 20 cents per day. You can cut that in half. Maybe even more. It could be 10 to 5 cents per day.
Exactly.
All right, so if you guys are okay with that, I would like to kind of wrap it up there with the Q&A and kind of take us to our next part of it. So just a heads up, it's very hard to think that we're going to fully master and answer all questions in one webinar session. We do want to stay true to people's time commitments that are in the community and have taken part as well. But right now, Alex, can I have you share your screen real quick? So what I do want to show you guys is for the people that are newer and still are learning and wanting to learn more and try to apply these actual skills. I'm going to show you guys how to actually trade with us for free and actually try out everything that you're actually learning about. So Alex, if you could go ahead and share your screen, and we'll go ahead and click on his stream. And we're going to take you through the site real quick to show you how you can actually trade with us for free.
Yep.
So if you click the watch stream, give everybody a second to get there. So the very first thing you're going to do is head to our website, stacktrading.com. Through here, you're going to actually head to services. In the top right there, the drop-down menu is going to go to live trading room. Now here in the live trading room, you can actually try us out for 1 week for free and to try to watch Alex, watch Taj call their calls live for you to actually try them out yourself. And throughout this entire experience, it is actually a very educational and informative experience as well. It is meant to educate you the entire time. And by the end of the week, you have the complete choice of deciding whether you want to trade with us or not. So what you're going to do is go to this code right here, and you're going to type in 2020. Now you're going to apply that code, and this is going to give you a free week of trading with us. We recommend this to all people who are either brand new or are just our community, to just purely get a look at what it is that we're doing in the markets daily. So once you actually sign up, what we're going to do is have a new trader orientation on Tuesday. Tuesday, you're going to come at 8 o'clock, and we'll be sure to message you as soon as you do. You can go ahead and keep that open, Alex. Be sure to sign up. And what it is that we're going to do, we're going to get you on a trading plan of how to actually succeed in your. So, yeah, Alex, go ahead and keep that open for me.
Oh, sorry, I closed it out.
Yeah, no problem. So now that is if you would like, once that week ends, you decide whatever options you would like to take. But usually from there, people decide what it is that they would like to learn more about. So what I love about these webinars is that you're getting to hear from our 3 educators, and notice how I'm listening and I'm learning, because these are our 3 educators of our 3 courses. So if you go ahead and click hit watch stream, I'm going to tell you just a little bit about Stack Academy. And this is for you to build that solid foundation of your learning. I'm a firm advocate that before we start actually trading with confidence, we need to have a firm foundation of our own knowledge. So Stack Academy is built with that exact mindset in mind. So go ahead, Stack Academy from our website. And from there, I want to show you the actual first one for our intermediate to advanced traders, people that are trying to take their trading to the next level. There's a way to do a boot camp with Alex. You'll get 2 days of very full and extensive or intensive sessions with Alex, where you'll get full access to him and learn everything you need to know in his entire trading playbook. So right here, you'll get the 2 days of intensive training. And this is where to sign up at. Now, again, this is for more of the intermediate to advanced traders. And how it is if you are a member or you are a subscriber to our community already, you do get a $250 discount. And you'll actually get that course for about $1,000. So if you go back up to the top, now if you are maybe not intermediate to advanced and you are still trying to build the basics, you're still trying to build your own foundation, you're still just kind of trying to understand maybe the complete basics and where to start, then you want to have what it is that Taj actually teaches, which is our starter course. So right here is our starter course. Taj not only provides interactive content for you, but he teaches a class once a week for you to actually ask all your questions, and you'll have access to him. So these are the topics that you'll see for you to read through on your own if you'd like, that Taj will actually be teaching on and touching upon. If you scroll down a little bit more for the people that are maybe a little bit more past the basics, you'll actually be able to study our options course, which has been highly reviewed so far, that Santi leads. Santi is the calm giant that you could see already. He teaches with a kind of poise, and really has the exact same style of classes. Once a week you're going to be learning the interactive content throughout the week, and you'll come to him for all questions for him to clarify. So with these 3 courses, if you scroll down, there's a way to actually save some money and to actually get the bundle, which again, please don't allow prices to scare you. Sometimes we do need to invest into the foundation of trying to build here. But you will actually save, again, $250 by buying both as a bundle. But again, it's up to you to decide where it is that you stand. We fully believe that everybody is on a different path with trading that they need to go, and whether it is they really just need to try the free week. We just want to be here to support you. We want to be here to serve you and to be the best leaders possible to push you in the right direction of your trading. Thank you very much, Alex.
All right.
So again, we try to provide as many resources as possible, completely free in this community. But what we're trying to show you is that there are many more ways to become a part of this team and a part of this trading community. So if you do find yourself ready to trade and ready to try us out, I would highly recommend that you actually take the promo code to our site and actually start trading live with us on Monday. Get a good feel for what this is like, because day trading can be very fast and it can be very up-tempo. You definitely want to feel comfortable going into it, so getting a free week to look at things can be very helpful. And throughout that week, we'll actually be checking in with you to kind of see how it is your trading is going, because we want you to be successful, 100% successful. And like Alex always says, we can't be successful if you're not. So here we are invested in you, into you, and making sure that we provide you with every resource possible to make sure that you guys succeed. With that being said, we thank you for coming to our webinar. If you guys have any questions at all, please message us individually, and all 4 of us, as well as Marilyn, who was the director of our customer relations, I will be glad to help you and point you in the right direction of where maybe it is that you need to go. So much love to everybody. We are loving our Stack community right now. We're loving seeing it grow. And yeah, y'all, hope you have a great night and a great weekend, and we'll see you Monday in the room.
Thank you, everybody.